Experts now expect the exact same pattern to emerge during the implementation of the SNAP work requirement system. Between May and September of 2026, a massive portion of those stripped of benefits are projected to remain fully qualified under the actual eligibility standards, yet fail the procedural process because the timeline is too compressed and the reporting structure too difficult to navigate. The evidence is already documented, confirmed, and impossible to dismiss. A third historical comparison now stands at the center of this debate. It comes from the 2018 Arkansas work requirement experiment tied to Food Assistance Administration, the closest and most relevant precedent for understanding what may unfold during the nationwide SNAP enforcement rollout. In 2018, the state of Arkansas introduced a Medicaid work requirement policy that ultimately caused 18,000 people to lose coverage. Yet investigators found no proof that those individuals had violated the core employment requirement itself. A detailed review conducted by researchers connected to Harvard University and the Urban Institute reached a striking conclusion. Employment levels among the targeted population did not rise after the requirement took effect. Instead, what surged was administrative failure. Many recipients received notices about the new reporting rules but could not successfully complete the online process. Some lacked dependable internet service. Others worked schedules that made portal access nearly impossible because the system operated only during limited hours. Those 18,000 coverage losses occurred inside a state with a relatively small Medicaid expansion population. But when that same pattern is projected onto the national SNAP framework, the scale changes dramatically. Arkansas represented only one administrative structure. The current SNAP implementation stretches across all 50 state systems at once. Every state operates with different portal technology, different staffing capacity, different error frequencies, and entirely different levels of political commitment toward reducing administrative churn. States willing to dedicate larger staffing resources and stronger support systems will likely experience lower rates of procedural disqualification. But the states choosing minimal support structures, many of which already carry the nation's heaviest poverty burdens and the highest SNAP participation rates, are expected to suffer the largest waves of benefit losses. That means the harshest impact of the national rollout is positioned to fall directly on the communities least capable of absorbing another economic shock. Attention is now turning toward four major indicators that will expose the real magnitude of the disruption triggered after the May 1st cutoff. Analysts warn the full damage will not appear in a single report. Instead, the consequences are expected to surface gradually through multiple data sets released between May and September of 2026. The first critical measurement will come from the monthly SNAP participation reports issued by the United States Department of Agriculture. These reports track enrollment totals, benefit distribution levels, and the average support provided to households nationwide. Data for April of 2026, representing the final month before the May 1st cutoff, is expected roughly 6 to 8 weeks after collection. After that comes the May participation report, the first data set reflecting the aftermath of the cutoff itself. The numerical gap between April and May enrollment totals will become the first hard statistical signal revealing how many individuals lost benefits immediately following the enforcement deadline. The second major indicator will emerge from food bank demand statistics gathered through the nationwide network operated by Feeding America. Across the United States, Feeding America coordinates a network of 200 member food banks that collectively provide assistance to more than 40 million people every year. The moment SNAP assistance is interrupted, the pressure hits almost instantly. Families losing those benefits do not wait weeks before reacting. They turn immediately toward emergency food programs in an attempt to replace what disappeared from their monthly support. That is why the surge in food bank demand between May and July is expected to become the clearest real-time signal of the damage unfolding inside local communities after the May 1st deadline. The lines at food pantries, the shortages on shelves, the growing number of emergency requests, all of it will expose the human impact faster than official federal reports. A third measurement now moves into focus. It comes from retail sales figures tied to food and beverage stores within the monthly reports issued by the United States Department of Commerce. SNAP funds are used overwhelmingly at grocery retailers. That means any sharp reduction in participation immediately echoes through supermarket transaction volumes nationwide. If SNAP enrollment falls by roughly 1 million to 2 million individuals, and each person previously received an average monthly benefit near $212 or around $380 per household, the effect becomes enormous. Economists estimate that grocery transactions could decline by somewhere between $160 million and $760 million every single month. That contraction will not remain hidden. It will appear directly inside the food and beverage retail category contained in the federal sales data. In other words, the policy's effect on consumer spending will become measurable at the national economic level, not merely inside individual households. Then comes the fourth critical indicator. This one centers on state-level SNAP error rate statistics collected by the United States Department of Agriculture to determine whether states comply with federal administrative accuracy standards. Under the new law, states exceeding the national error threshold face significantly harsher penalties. That single change creates an intense financial incentive for states to enforce the updated requirements as aggressively as possible. And there lies the trap. States pushing hard enforcement in order to avoid federal penalties are likely to generate much larger churn numbers as recipients lose benefits through procedural breakdowns. Yet, states choosing a slower and more cautious implementation to reduce churn face another danger entirely. Higher error rates can trigger federal punishment, shrinking overall SNAP funding and creating a separate pathway toward reduced assistance. The result is a system where every option carries consequences. Aggressive enforcement produces more immediate disqualifications. Conservative enforcement risks funding losses later. Either direction places pressure on vulnerable populations already struggling to survive. Within the next 48 hours, additional state-by-state evaluations are expected to reveal which governments implemented the requirements most aggressively and which regions are now experiencing the highest churn levels. The analysis will also identify states using local funding to preserve benefits for groups impacted by federal cuts. It will further expose the exact administrative portal failures connected to the documented EBT card decline incidents that Marcus Del Rey described at the Memphis Kroger location, alongside the measurable spike in food bank demand now spreading through communities nationwide. At kitchen tables, inside checkout lines, and across crowded food pantries, the consequences are already becoming visible. 50 million Americans did not wake up on Tuesday morning staring at empty balances because a government official intentionally sought to hurt them. They encountered zero balances because an enormously complex policy was forced into systems that lacked the administrative strength required to manage it effectively. And it arrived under a deadline that gave the people most affected the least amount of time, preparation, and resources to respond. That is not political rhetoric. It is the repeatedly documented outcome seen throughout the history of major government benefit restructurings across American social policy. The so-called One Big Beautiful Bill delivered one undeniable result on this particular Tuesday. Families checked their cards and found nothing there. Zero balance. Yet the hunger inside those households did not disappear. And across communities where food assistance marks the fragile boundary separating stability from crisis, the economic aftershock tied to 42 million disrupted accounts is now spreading far beyond grocery aisles. That expanding shockwave may become one of the missing pieces behind the slowing consumer economy, the weaker retail sales numbers, and the broader economic deceleration that has been unfolding since the beginning of the Iran war. While much of the mainstream financial press still treats these developments as isolated events, a deeper connection is beginning to emerge. There is a direct structural relationship between the SNAP disruption and the banking system stress pattern already documented in previous financial analysis. That connection matters because it links food assistance failures to wider pressure inside the American financial system itself. SNAP payments move through electronic benefit transfer cards, commonly known as EBT cards. Technically, those cards operate across the exact same payment infrastructure used for standard debit card transactions. The system handles billions of dollars in annual purchases through identical point-of-sale terminals, the same network processing architecture, and the same settlement systems that grocery stores use every day for ordinary banking transactions nationwide. The financial institutions responsible for managing EBT accounts are banks contracted by state governments to issue and administer those benefit cards. That network includes major national banking institutions, as well as smaller regional lenders and community banks. When SNAP interruptions occur on a large scale, the transaction flow tied to those EBT accounts immediately weakens. For the largest national banks, that decline is not substantial enough to meaningfully damage balance sheets. But the situation looks very different for regional and community banks operating in states with heavy SNAP utilization and large government processing contracts. Inside those institutions, EBT transaction fee income represents a documented revenue source. During the opening weeks of May in 2026, that revenue stream already began to contract. The pressure does not stop there. Grocery retailers serving neighborhoods with elevated SNAP dependence are now facing their own revenue deterioration. Many of those businesses rely on revolving commercial credit lines provided by regional banks in order to sustain day-to-day operations. Consider what happens when a supermarket earns roughly 30% of its weekly income from SNAP-based purchases. If those transactions suddenly fall between 5 and 10% during the first weeks of May, the result is an immediate operating cash flow problem. Thin-margin retailers already struggling under weaker consumer demand now face an additional shock directly tied to suspended SNAP benefits. And this matters because many of those businesses were already heavily dependent on borrowed liquidity. Consumer spending slowdowns connected to the sadder summer economic environment had already reduced top-line revenue across large portions of the retail sector. Now, another layer of financial stress has been added on top. That means credit line utilization is climbing precisely where local economies are most vulnerable. The commercial loan portfolio pressure previously identified through Goldman Sachs single name impairments and the 42% increase in non-accruals reported by Citigroup is no longer confined to high-level banking reports. Its downstream consequences are now appearing inside grocery chains and food retailers operating in communities where SNAP disruption has become most severe. What began as an administrative benefits crisis is rapidly evolving into a broader financial strain touching retailers, lenders, regional banks, and local economies all at once. And this story is still developing. Stay with us as more state-level data, banking exposure reports, and retail impact numbers continue emerging in the days ahead. The next phase of this crisis may reveal just how interconnected America's food assistance system has become with the stability of its broader economic foundation.